What is up, everybody? Welcome to another Monday morning market update. I am Sean Grapevine, co-branch manager of one of the Atlanta branches of UMortgage, and I'm excited to join you. It's like Super Bowl week for mortgages for fixed rate for the Fed. So I'm excited to jump into that with you, and I am joined to do that with you by the man, the myth, the legend. He's the Mac of the rate stack. He has bips for breakfast. He does best efforts with no effort. His GPA at the University of Texas was higher than today's 10-year T-note. He's the titan of that 10-year. He's the Baron of bips. He's the Lord of the locks. It's Austin Koenig.
Hey, Sean, thanks again for hosting the Monday Market Update with me again. It's always great to have this conversation on a Monday morning, and it's funny that you bring up the Super Bowl of mortgage rates. You're kind of alluding to obviously the Fed meeting this week, but I guess the Super Bowl's been decided for football, and both of those cities that are playing Super Bowl have a Federal Reserve location in their city. So
Wow.
there we go.
What are the chances? Pretty high. But, I mean, also,
Yeah.
what are the chances?
I don't think there's one in Cincinnati, so there we go.
Yeah. Unfortunately, there is one in Atlanta, but there are no Super Bowl participants from Atlanta, and don't look like there will be anytime soon. RIP 28-3. I hear you guys out there saying it already. 28-3. We get it. It was traumatic. Don't bring it up. Well, thanks for joining me. So we got news coming, but let's go over last week first. What happened in the news?
Yeah, so obviously our other secondary measure of inflation, PCE numbers came out. Really think about PCE as the same sort of thought process of like kind of CPI in general, just thinking about a basket of goods in a way of like how expensive has this gone up year over year, and what is your dollar working for you as essentially kind of looking at inflation and just another measure. And looking at the PCE numbers that got released, no drama really, I would say. Everything tailed down. Like if you're looking at year over year, just the headline PCE is 5%. That's for December's data. Obviously, if we're looking back to like what got released in October, which was September's data, PCE was at 6.1. For core PC, which is excluding like food and energy and everything like that, we're seeing 4.4 was December's number, compared to, September was about 5.1. So, we're seeing the story of cooling inflation, but this is also just obviously getting to hotter data that is now being encompassed year over year.
Mm-hmm.
But we're not seeing inflation stay red hot. It's more so it's sticking. I think a lot of the things that are keeping it high is the stickier factors, such as rent, that I think take a little bit of time to show up in the data. But at the end of the day, I think if you look in the right places, you can kind of understand some of these things are also cooling off too. So I think the general consensus from the market was good, no drama. We're looking to the Fed this week. I wouldn't say there was a huge reaction behind PC last week.
Nice. Okay. So yeah, not a huge reaction at all. In fact, interest rates sort of creeping up a little bit after faking their way down. It seems like the market is like, all right, PCE, that's great. We've got our CPI, that's great. Like CPI dropped into 3.4s for the 10-year. Now we're back into the mid 3.5s, and it seems like everybody's just waiting on a bated breath for this week to see what the Fed does. And this is probably the biggest like chance of surprise week we've had in a long time. Is that right? So like in the past, it was like, oh, it's going to be 3/4. Oh, it's going to be half. So now we could be looking at no raise, a quarter, a half, right? Like they're all kind of on. It's the first time we've had three options on the table in a long time.
You're 100% right, Sean. I think really the thing that's priced in here is a lot of people are thinking this is a 25 bip hike we're all looking at right now. And obviously there's risk on either side of that, of it being something different. But what the market and kind of like the policy makers have all kind of almost agreed upon is a terminal rate of where like the Fed caps out their rate hikes. It's sitting at about 4.9 right now. So what does that mean? right now, like the Fed funds rate is essentially 4.5, and we're expecting it to go up to 4.75. But basically, it's a coin flip between everyone that participates in this kind of survey, or just kind of projecting out what the Fed funds rate is.
Mhm.
There's another 25 big hike beyond this one that we're having here.
Mhm.
So,
There's multiple unknowns.
exactly. And really, and on top of that, if we're looking at, where everyone's kind of agreeing upon what's kind of priced in right now is kind of like 1.5 hikes of 25 bips. What's not priced in in a very consensus manner is where we start to see a pivot and the timing behind that. So like where does the Fed
Like
funds rate?
as in not only stopping but actually lowering rates.
Exactly. So kind of where do we end at? December 2023 is rolling around. If we had to do the market prediction between Rob and myself again, right now, what is the Fed funds rate, December 31st, 2023? Uh,
Man.
no one seems to have a really great gauge on that one, because
Huh.
some people think there could be, 50 bips of cuts priced in. There could be no cuts. It's a lot of uncertainty, and I think that like any year, there's a lot of things going to happen over the course of this year. But that is the part that I think is really not priced in, and the Fed kind of playing their cards on that one. I think is the one that moves the market more so than saying, oh well, we're still looking at maybe another hike. I think that can move markets a little bit, but
Mhm.
I think people can stomach that. I think it's more so where in the world does later in the year look like, and that's kind of where we're going to start playing the guessing game again. As data rolls through more in the middle of the year, and we're
Well,
kind of seeing how the economy fares.
let me ask you this. So will the Fed lower rates if things are fine? Or like I always assumed that lowering rates, and it seems to me like the Fed, especially now because they ran out of room so quickly the last two rounds of like quantitative easing, is like they're not going to lower rates unless there's something wrong with the economy from now on, right? Like they're only going to do that to increase like productivity or production, and whatever, like heat up the market a little bit. So is there really any? I mean, the only reason we expect rates to go down is because of bad news. Is that right? Or like do they play with it, go up and down a little bit, just sort of like on a smaller, sort of more granular scale?
Yeah, Sean, I think this is a great point to bring up, because that's exactly the conversation that's going to be happening as we get to the second half of this year. It's
Mhm.
it's 100%. What is the Fed actually going to stay at? Like, is the terminal rate of 4.75 or 5% too high to stay at for a year or two? I think really, when you think of anything, a rate cut in like just a vacuum essentially is a stimulation move. So you want to try to stimulate the economy, make money cheaper in a sense, make investments cheaper. Think about it like this: if you're running a business and you want to like you're running a restaurant and you want to add on like a whole nother dining room, how much does that cost for me right now? If the loans for that business are cheaper than if they're really expensive, it might make more sense to just wait a year or two before rates go down, or it becomes more of a easier break even for me to do. And so like when money's really cheap, it's easy for that person to maybe expand the restaurant or whatever the case is. So those are like the micro decisions that this all affects, right? And at the end of the day, what the Fed needs to decide is inflation under control, and do we have the ability to stimulate the economy to pick up growth? And do we need to pick up growth? Is the job market hurting? Do we need to create these investments to become cheaper so people get hired more and everything like that? That's where I think it's kind of like a lot of different factors. Like we've always been talking about the jobs and we talk about inflation data.
Mhm.
It's still going to be the same kind of song and dance a little bit, but it's also what does the Fed need to do to stimulate the economy, if they even need to stimulate the economy in the first place? So those are the kind of things I think are all going to be playing in loop, I guess you could say, the second half, and seeing what the Fed actually goes and does. Some people think that they should be lowering the rates. Do they actually do it? Do they feel they need to do it? That's kind of TBD, and obviously
Mhm.
no one wants to cut it too early for the reasons of like inflation picking up for whatever
Sure.
reason again.
What? Okay, so say again. You said like most people, the consensus is that the Fed funds rate is going to stop going up at about like 4.9. Like that's kind of the target rate. Is that right?
Correct.
Okay, and so assuming we hit that, and then like no raising rates, no lowering rates, that's where we hit. What are mortgage rates at if the Fed funds rate sticks at 4.9?
It's a good question. It really depends, Sean. I think at the end of the day, what has to happen is mortgage rates are kind of influenced one by the Fed's policies, right? But it's also the investors and that side of things. So the Fed can play with mortgage rates in a couple different manners that aren't really just the policy of hiking or lowering rates. It's also they have all these MBS bonds on their books. Do they decide to actually outfloat any of that? They're probably never going to step into the market in the near term future or really ever in the future again. So who's going to be coming up to buy MBS and provide that demand and kind of getting it a little bit closer to treasuries in terms of what the yield needs to be essentially. So I think where we need to see things actually have to happen in the world of MBS is banks return to becoming a big investor in this space, and that could really help mortgages. I think we could see realistically, maybe a 5.85 average note rate, at the end of the year, but I think that could be hard to get to if we don't see any cuts or kind of like some sort of easing, I guess you could say. So I think probably around the low sixes or high fives is a fairly good range to think of, but when we're thinking about the end of the year, but that can be completely way off based off a lot of different things, right?
Nice. All right. Well, I don't mind low sixes, high fives. That's a totally originatable level, as we're seeing like in our branch. And I know I've seen and company wide as we're hitting like lock record after lock record. Like it's pretty. Yeah, people are okay with low sixes and even mid sixes and high sixes. So. I'd be thrilled to be there. How's it been on the lock desk? Like we're double, what are we're up like 50% from December in terms of like total locks in January, something like that, up 30-50%. Like, are you guys feeling it? Is it feeling pretty spicy? You guys busy?
Yeah, I mean, there's obviously the LCs are very much in tune with locking loans up front, and we're continually training them on all this sort of nuances about locking loans. But here's the thing: it is getting pretty busy. We're seeing like record lock days, and we're also seeing just continued growth. I think we're ending up around the 170 mark for locks last week. That's really pretty high. That's we're not even talking about 50% growth. We're talking about almost like 100% growth to some of the places we've seen in
I love it.
January, like from January all the way to December. Now I think a lot of things too, Sean, you're exactly right about what you're alluding to earlier. It's hard to when the average mortgage rate is around 7 plus, like it was in October. That's a tough market, and that was also approaching winter, purchase season. It's a very cold market in general in terms of like the amount of activity when it's only purchase. So when we're looking at January, kind of looking into spring, I think a lot of people are seeing the pickup already starting, and rates at the like low sixes, even high fives. People can kind of stomach that affordability a lot more than what they were seeing late last year. And I think this is just generally a better marketplace for all, not only like for every LO that we're adding onto mortgage, but I think those that are already here, they're seeing their business pick up just generally because I think the market conditions obviously varies regionality, but I think there is some pickup going on nationwide, and just in terms of like a little bit of movement happening in the purchase market.
Yeah, for sure. It's definitely, yeah. I mean, and there's some pent up demand. Obviously there's plenty of pent up demand from along into 2022, but there's even pent up demand, I feel like, this month from the nationwide 10-day snowstorm / holidays / just weather in general. So I think you're absolutely right about that, right? Like there was like whole swaths of the United States that like couldn't leave their house for a week plus, so they weren't house shopping. Hey, well, what do you think about hopping on a quick call after Mr. Chairman Powell's remarks on Wednesday and kind of trying to parse out what's happening, trying to maybe watch what's happening in the mortgage market, and just take a 15 minutes to give everybody a quick update.
I think it sounds great. Let's try to do something there. Definitely, I think around 3 o'clock Eastern's when things are starting to really come to fruition. So, let's play by ear and let's plan something so we can get some feedback out to the broad audience, and I think that'd be great.
That sounds like a lot of fun. All right, sweet. Well, we'll do it. Thank you as always. Wonderful catching up with you on yet another Monday market update. Anybody who has any questions, drop them in the comments. I will watch Austin answer them, and we'll get back to you ASAP. So looking forward to seeing you guys on Wednesday, I think at 3 p.m. Keep an eye out. We'll make an announcement, and we'll parse out how the Fed has decided to move forward for this month and the months to come. So have a great day, everybody. Have a great week. Go lock some loans.
See ya.